So broadly, our experience has shown over 13 years that, of course, there are just three natural types of exits, other than the collapse of a company, which is the write down. Those are M&As, secondaries, IPOs. And all three of them are very different in when they happen, why they happen. And, uniquely, they kind of converge around the point of a IPO. So I'll come to the IPO last. So in the M&A cycle, we've seen that it could happen when things are not necessarily taking off. The lack of PMF, the lack of capital. So there is a combination of acqui-hires, distress M&As, and then as the company gets into a certain rhythm and momentum, with each round, it reduces that probability of needing to get acquired poorly, and acquired strongly becomes the narrative. And why does it then get acquired? Usually it's a consolidation in the industry, or a very large player wants an entry into that geography or segment, and so that's how M&As happen. So the three phases, in my opinion, of M&A, and we can double click on that in a bit. Secondaries, we've seen are, in the early stages, are a consolidation of trying to give angels a good return and become more institutional. And as the company breaks out beyond like the $500 million mark or so, you start seeing larger players wanting to come and own more, and they're willing to give earlier investors a piece of their liquidity back. And then in the IPOs, and which is why we're big fans of IPOs now, it should have always been, but it took the ecosystem some time to get to the idea that IPOs are actually a powerful concept for a founder to think about. One, it orients the founder to building very long term. Right? So fundamentally, the primary purpose of business building is perpetuity. Various accidents happen along the way and various outcomes happen, but not necessarily for the company. So it's the company, then the founders, then the investors, in the order in which you should prioritize in the ideal world. So the company planning for an IPO looks like it's a path to profitable, scalable, predictable company. The minute that happens, everyone wants a piece of the action. So a Tata Group or a Reliance will come and say, I can buy this because I know it's cash flow accretive. A IPO investor says, oh, I'd love to own a piece of this technology, which I don't get a piece of today in the public markets. And the sort of premonition of these two mean that large investors say, oh, now I want to consolidate and buy these stakes before it goes public. So there's a lot of pre-IPO secondary suddenly. And we're beginning to see that in some of the largest companies in this country, which are on their path. The ones which are not on that path to profitability, etc., are struggling. They don't get any of these three. There's nobody who wants to show up and say, I'll buy a company that's guzzling cash. The IPO market says, hey, you're still far away from me getting comfortable with predictability or profitability. And the secondary guys are saying, why would I buy and give liquidity to someone else when I don't know whether this is going to be sustainable by itself? And so you're a triple whammied when you're not a path to IPO company versus an IPO company. So this has been our learning. We've been advocating this gently for the last 5 years and now more aggressively. Hi, this is Karthik Reddy. I'm one of the co-founding partners at Blume Ventures. Thank you for watching, and please subscribe to our YouTube channel for some wonderful content we're bringing to you.